So, sir, what do these developments mean for our economy? In February this year, MTI upgraded Singapore's GDP forecast for 2026 to 2 to 4% on the back of strong growth momentum seen in the fourth quarter of 2025, supported by robust AI-related demand. Early data indicates that economic activity continued to be resilient in the first quarter of 2026. However, growth in the coming quarters is likely to be affected by the ongoing conflict. While the conflict impacts many sectors, some sectors will feel it more than others. In manufacturing, the most direct impact will be on industries that rely on natural gas, crude oil, and crude oil derivatives as feedstocks. Our refineries have adjusted by reducing their run rates and brought in shipments from sources outside of the Middle East. Downstream chemical firms will also be affected. Some firms, such as PCS, have already declared force majeure due to upstream supply disruptions. Beyond the energy and chemical clusters, higher fuel and electricity prices will also affect a wider range of industries, including electronics, precision engineering, and other energy-intensive clusters. In services, outward-oriented sectors like air and sea transport, as well as tourism, will be affected by higher costs and weaker demand. On the other hand, domestically oriented sectors such as retail, food services, and private land transport will face higher operating costs, including utility and fuel. Taken together, these sectoral impacts will weigh on economic activities in the coming quarters, although the extent remains uncertain as the conflict is still unfolding. MTI will continue to monitor developments closely and will update our GDP forecasts in May. Let me now move to the impact on Singaporeans. As we import nearly all our energy, the spike in global oil and natural gas prices will inevitably raise fuel and electricity costs for Singapore. About 95% of Singapore's electricity is generated from natural gas, whose price is mostly pegged to market prices. The regulated electricity tariff, which most Singaporean households pay, increased by 2.1% to about 27 cents per kilowatt hour for the second quarter of 2026. The increase is modest relative to the spike in fuel prices. But that is because the tariff is based on fuel prices from the first 10 weeks of the preceding quarter, from January to middle of March. That means only a small portion of the recent surge in fuel prices has been captured in this tariff adjustment. Fuel makes up about half of the tariff, so higher fuel prices will flow through to electricity prices. We should therefore expect a much sharper increase in the next tariff adjustment, which will fully reflect the higher cost of fuel. These cost increases will feed through to broader inflation in Singapore. We had earlier forecast CPI all items and MAS core inflation to come in at 1 to 2% in 2026, after inflation broadly eased in 2025. However, the Middle East situation has driven up global energy and commodity prices, which will drive up global inflation. Consequently, we now expect Singapore's overall inflation for 2026 to be higher than earlier projected. If the conflict is protracted, higher inflation in our source markets could also lead to further increases in import prices over time. These pressures will be felt by households in more expensive electricity, transport, and daily necessities. Lower-income households will be more affected as a larger share of their spending goes towards essentials. MAS will take these developments into account in its upcoming assessment of the inflation outlook, which it will release on 14th of April.